Hello, everybody. Thanks for joining us today. It's
There we
September.
go.
Got some good stuff to talk about. Charlie, thanks for joining again. I think it's been a couple months, 3 months since we did this last time. So excited to have you back.
Yeah, definitely. Thanks for having me. It's going to be a fun hour here, so stick with us to the end. We have a lot of interesting topics to talk about.
Yeah. Speaking of which, we've got an agenda. We're talking about the case for and against cutting rates. Might be too late to make that case, but we'll get to that maybe in the second part when we talk about how the rate cuts are coming. Yield curve making a comeback as far as being newsworthy. Talk a little bit about AI because you can't talk without talking about AI. We got to get it in there. History rhyming, and then we'll talk about tech and whether it's too late to invest in tech, I guess. But quickly, for anybody that doesn't know Charlie, you have a new name for your blog, right?
Bilello.blog.
Well,
Yeah, check it out. And that's the main site. Go to YouTube Creative Planning, creativeplanning.com/Charlie. And of course, X is the
yeah,
main event.
I was just talking to Tanya. I said, Charlie's Twitter handle is still at Charlie Below, right? And she said, we don't call it Twitter anymore. So, but I think everyone
That's
still
right.
does call it Twitter, right?
X is yeah, it's hard to get used to it, especially with the tweet. Like I still call it a tweet, even though I'm getting used to X. I can't get used to calling it a post instead of a tweet. But
I agree.
baby steps.
Yeah. Also, so don't forget to subscribe to the YCharts YouTube channel. That is the best way to get a replay of the webinar. The webinar will be up there soon. Anybody that subscribe or register for the webinar, we will send out a copy of that as well. But I think that's going to come out Monday. So if you need to get to it sooner, you can subscribe to our YouTube channel and check it out there. And of course, as always, keep in mind that the things we talk about today are not investment advice. YCharts is not a broker dealer acting in any type of capacity to offer investment advice. So this is just for educational purpose, maybe a little entertainment too. But let's jump right into things. Okay with you, Charlie?
Absolutely,
And
let's do it.
we're going to talk about the case for and against cutting rates. So let's first, I guess, talk about the case for cutting rates. But before you get into the case here, I wanted to maybe start just by asking you a question, right? So I think the whole concept of rates and cutting rates has become a very mainstream conversation, right? Something that typically my mother-in-law wouldn't ask me about, that's changed. What do you think the general public or the average consumer is expecting to come from a rate cut or getting them excited about rate cuts?
I think it's a split probably down the middle between excitement and people who are against it. So on the one hand, you have all the people who've been earning 5% on their cash for the first time in a long time, and that's been an enormous boost to anyone who has a lot of savings and keeps a certain percentage in cash. And they want that to continue. So the adjustment there is going to be they're going to that 5% rates, as we'll talk about in a little bit, are going to be over. The other side is, of course, anyone with debt, particularly floating rate debt, credit card interest rates are at record highs above 20%. That group is going to see some relief with these rate cuts. There's some relationship there. So Fed cuts 200 basis points, let's say, in the next year. You're probably going to see lower credit card rates to come, lower auto loan rates, which are obviously high as well. Mortgage rates have already been coming down. They might come down a little bit more as well. So if you have existing debt that's already low interest rate that's locked in, you don't really care, and you have a bank account with cash in it, you probably want the Fed to keep rates where they are. If you're looking to take out new debt or you have this floating rate debt, well, then you're probably thinking, yeah, the Fed should start cutting interest rates. And then, of course, we have the federal government, which, as you know, is very incentivized to have lower interest rates. We're at 35 trillion in debt. We're now spending over $1 trillion a year just on interest payments, and it's been rising pretty rapidly. It's the second biggest line item in the budget now. So that camp as well, obviously wanting lower rates. So many
Yeah,
different people benefiting and hurting from higher or lower interest rates. So it's not a clear cut case one way or another.
Yeah, I guess it's felt a little bit like the idea of cutting rates has just been synonymous with people's well-being get a little bit better. But let's get into it. So let's talk
Yeah.
first about just where rates are and where inflation is.
Yeah, absolutely. So the number one case would be you just look at this chart, right? And that's what people are saying. Can't can't you see? Can't the Fed see that inflation has come down? This is the camp that's saying the war's been won. The Fed is behind the curve already because they have a Fed funds rate above 5% and inflation's moving lower. We got the CPI report this week, 2.5%. That's the lowest for inflation in the US since February 2021, when, of course, rates were at zero. Core inflation still above 3%, but it's been trending lower. It's expected to trend lower in the months ahead as shelter kind of catches up to real time data. But this is the biggest case people are making, saying we don't have to be worried about inflation anymore. That's been solved. This is going back to 2%. That's the Fed's target. We don't have to wait exactly till it gets to 2% before the Fed should start cutting rates.
Too many slides there. Right. So you mentioned that target, right? So the Fed targets that 2%. They like to focus on core PCE, right? But I mean, that's been the focus of their policy, but they've been raising rates all along, right?
Yeah, so core PCE is their preferred measure. Again, that's still above 2%, but I guess in the Fed's view, it's come down enough, it's close enough. Again, they're projecting it to come down some more. So they're saying, look, we have some room here to cut because we have a Fed funds rate, the lower bound's at 525. And that spread between that Fed funds rate and core PCE inflation is the widest it's been since September 2007. So it's very restrictive policy. And the question, of course, is do they have some room, right? They're going to start out, as we'll talk about, I believe, with just 25 basis points, and then they'll continue from there and kind of reassess. But this is the viewpoint saying we don't have to be this restrictive anymore because the war on inflation's been solved. And now, as we'll talk about on the next slide, the focus should start to be more on employment.
Right. The Fed's second directive, right? Keep inflation in check and keep employment at max.
Right. The dual mandate, right? Stable prices, which, as we talked about in 2021, they completely ignored, right? As the inflation rate went up and up and up, they ignored it
It was
in early
transitory.
2022. Yeah, it was transitory. Obviously, it didn't turn out to be. But back then, we're not talking about the unemployment rate. Unemployment rate, hit its lowest level since the 1960s last year. We're down as low as 3.4%. But since then, it's risen a little bit here. It's risen as of July, 0.9%. It ticked down a little bit in August. So it's up to 4.2% now. But I just looked back in history and said, well, what has happened historically when you had the unemployment rate rise this much off of a cycle low? And what we've seen here in this chart is every single time the economy was either already in a recession or about to start a recession. That would be 2020. 2020 you can kind of throw out. Of course, it came on all at once. But look at the other data points there. It's pretty remarkable how consistent this data point has been. And so that would be the argument to say, well, we're going to perhaps be in a recession or at the very least a growth slowdown in the next year. Well, the Fed needs to get ahead of that by stop being so restrictive, start easing policy again, at least start moving in that direction.
I see you made a good case for rate cuts, right? Unemployment rising, signaling a recession, inflation, coming back down toward the Fed targets. What would the case possibly be against a rate cut?
So this is an important concept, Caleb, because whenever I talk about inflation on CPI day, people right away like shout at me saying, yeah, just because prices are up 2.5%, that's the lowest since 2021, doesn't mean prices are going down. And they're right. I often tweet that as well. But this chart really tells that story in terms of we have this inflation target of 2%. and we could argue whether that's justified or not all day long. Why should it be 2%? Why not 3%? Why not 1%? Doesn't matter. That's the target. We've been above it here, 11% above it now, looking at the cumulative inflation since January 2020, with all of that inflation over the past few years. That's where we are placed above it. So to me, we're down to 2.5%. That's great. And hopefully it continues to move lower, but that doesn't erase the cumulative inflation above that. And prices overall are still hitting new highs and we're still above 2%. So my preference and why I would say, let's hold the line here until we get closer to this trend line is, what about this cumulative inflation? Do we just forget about it? And that's fine, but we can't ignore it. Like, so have a 2% target. If I think we might have talked about it on the last live show we did. If you go 2%, 2%, and then there's 10%, 8%, and then you go back to 2%, is that 2% inflation? Well, yeah, it is today, but you can't really ignore what happened in those spike years, right? Otherwise, it's not truly a 2% target. But I think that the Fed never addresses this concept. All they're looking at is that year over year inflation number, and it's forgotten. Like the cumulative stuff, okay, that's gone. That's the past. Let's not worry about it. Let's just try to keep it at 2% going forward.
So Charlie, would you want to see the CPI actually start to decline?
I wouldn't mind it. I know there's everyone talks about deflation, and they bring up the depression, and they go right to the most extreme thing. And maybe it doesn't have to decline, but I would certainly wouldn't mind it to be below 2% for some period of time, so that incomes catch up with this growth. That's been the big issue for the American population, particularly lower income people. Many of them, their incomes did not keep pace with it. The inflation, whether it's food prices, gas prices, a number of other things. And they're just starting to catch up now, which is great, but it's not enough yet. So why push over to easing? Why favor higher prices at this point when we're still well above it? I mean, it's a valid debate to have, but I think to honestly say you have a 2% target and then kind of ignore it when it goes way above it and just say we just need to get back to that 2%, it's kind of being dismissive of all of that excess inflation that we had in the economy. So yeah, I would not mind, and there's not many people arguing that. Why is lower prices outright bad? It's not bad when you're buying a TV today versus 5 years ago or 10 years ago, when that semiconductor chip keeps getting better and better. You wouldn't mind if your iPhone price went down, or for a number of years it was the same price over 5 years or 10 years. It keeps getting better. So that's all of that is deflation. And we don't complain about it. Technology is by inherently deflationary. So I don't think the concept of like talking about depression has to be the comp. But overall, Caleb, I would say just keep sound money, keep a stable money supply, keep a Fed funds rate in a position where it's not leading to excess inflation, and we'll be in a much better place than we've been in over the past few years. So don't do the things that we did in 2020 and 2021. I'm not confident that the Fed isn't going to do that.
And shelter's still leading the way as far as being kind of above those targets and inflated, right? Very appreciated.
Yeah, this is the biggest component, right, of CPI. It's over a third of CPI. It's the biggest single factor in terms of what people spend money on. And if we look at home prices versus incomes, you can see more than double in the past 5 years. Home prices have more than doubled the rate of appreciation versus people's incomes. And the argument that the Fed should be cutting interest rates kind of ignores this component, right? So anybody who's in the younger generation or looking to buy a home, we know it's unaffordable, right? And based on people's incomes. So what I would say is keep that rate higher here. That would be the case against cutting until this kind of balances out more. And we're seeing a lot of positive signs. I don't have a chart here in terms of the rental market, where rents are actually flat over the past few years since the Fed started hiking rates. Rents on a inflation adjusted basis actually are moving lower. So that's a very good thing. Let's keep that going. The number one thing for an economy in terms of its health in the long run is having affordable housing. Right? You don't want to see housing become such a big percentage of people's spending, and that it's crowding out investments in other areas of the economy. So what the Fed did, in my mind, in 2020 and 2021 was so egregious in terms of essentially throwing gasoline on a fire by buying mortgage bonds, buying trillions of dollars in mortgage bonds when the housing market was already on fire, and they sent interest rates below 3%, and the housing market's going to be frozen for who knows how long directly because of that, right? People are locked into those rates. Prices jumped way up because of that huge spike in demand and because of the increase in the money supply. And now the Fed has to deal with it. They never talk about it, but they have to deal with the consequences of that. So in my view, this is not just an interest rate thing. Fed still has a lot of mortgages on their balance sheet. They're slowly letting those roll off. But if it were me, I would be more aggressive getting out of the mortgage market, letting this normalize. But there's not a lot of push for that. So all of these
But
reasons
Charlie,
against.
wouldn't lower mortgage rates be like the thing that will bring supply back to the market and help this as well? And when lower rates help those mortgage rates start to, they're
Yeah,
probably not going to get back to 3%, but
it'll be interesting to see. We've never been in this type of situation, right? So we never saw what happened in terms of supply coming collapsing essentially when rates rose. Like this concept of the lock-in effect, we'd never seen that before. Right? We never had a situation where mortgage rates went from below 3% to 8% in a few years, right? And then everybody who locked in those lower interest rates said, I'm not going to move. It's just starting to ease now, even with interest rates not really going down meaningfully. It's starting to ease because eventually people have to move. Either they have a job shift, something happens in their family, there's a shift, right? They have, just kids, they need a bigger home, they're relocating, they're in retirement, and not everyone's dependent on a mortgage. And most, more and more people now don't even have a mortgage. I think the number is close to 40%, right? So those people are unaffected in terms of deciding whether to move. But yes, that's been a big factor, and perhaps that could happen. Mortgage rates could go lower to 5%. We see more supply and prices go down, but I don't think that happens, Caleb, without economic weakness. Like, I don't think you see a meaningful correction in home prices. Historically, it's very tied to employment. It's very tied to wage growth. And the two times in history we've seen that diverge is in the 2000s bubble, and then today, in terms of home prices being so far above income growth.
and you mentioned wages. So, we looked at the wages compared to home growth, but here you've got real wages and what's happening with that growth.
Yeah, so this would be the argument, Caleb. Like, we were doing these webinars back during that 25 consecutive month period. It was brutal, right? Like, inflation was over 9%. The Fed has barely hiked at that point a few times. You're like, what are they doing? They have to bring that rate down, right? You have to start being aggressive here and attacking it. Treat it like an emergency. Treat it like like they treated the situation in 2020 when they immediately dropped rates to zero. So we're in a good place now, right? Wages are outpacing inflation for 16 consecutive months. To me, that's great news. This is the best sign for an economy. And if you think that CPI is going to continue to trend lower, that's awesome, right? This is what is keeping the economy going. This is why it's hard to see, for me, looking here and now, it's hard to see a recession beginning with this type of backdrop unless you start to see a real pickup in layoffs, and we're just not seeing it yet. If you look at jobless claims, they're not meaningfully higher. They're actually, I think, lower than they were a year ago. They were trending higher, a few weeks ago, but now they're starting to move back down. And what I would say is the Fed should look at this chart and say the goal is positive real wage growth. The goal isn't just to stimulate for the sake of stimulating and ease for the sake of easing. It should be setting an interest rate where it's a best point for the economy. And my view is they don't know where that interest rate is. Caleb, and this is the most important point. Where would short-term interest rates, let's say 1 month T-bills, 3 month T-bills, that's what the Fed controls, right? They're buying and selling those to set them within their target range. Where would they be if it was just based on supply and demand? I don't know. Would it be 7%? Would it be 5%? Would it be 3%? It might be lower today, and that's fine. But let the free market determine that, not 10 people sitting in a room pontificating about this and that. When we know they're using lagging data, they have their own bias, their own agenda. They always have a bias towards easing, just like the federal government always has a bias towards spending more money and deficit spending. They have the same bias, right, to be easy because they get rewarded for that and they don't feel the punishment, right? Even when we have that spike in inflation, how many people are blaming the Fed for that? Like everyone's talking about, like the Fed's engineering a soft landing. They're doing such a great job. Like, what about what happened before that? What about when they increased the money supply by 40%? We just forget that part. So my overall view here is that the Fed has no idea what they're doing. They're looking at lagging data. They're going to cut interest rates because of that chart we showed earlier, showing that the Fed funds rate is now a few percent above inflation. But are they too late? Are they too early? All these arguments, we don't know, right? The market knows, and we don't know where the market would be because we're manipulating. And we're not the only ones who do this, of course. It's kind of remarkable that every free market economy has these central banks that are trying to set the rate that is going to be in a perfect place for employment and inflation. If Caleb, if that was the case, would we have that big inflation spike that we saw to 9% if they were able to do that? Would we have the global financial crisis? Would we have the Great Depression, right, which the Fed was around for then? No, of course we wouldn't, right? So, but we're going to keep pretending because that's what the game we're playing. And so regardless of what I think, the rate cuts are coming.
They are coming. It's fun to debate, but we'll give you a chance for your heart rate to get down here just a little bit here, Charlie.
I just want to be let into the press conference, and they won't let me in there. And
they still won't let you in.
It's unbelievable.
I thought we were going to pull some strings for you on that one. But
if you know someone, please do. I have a lot of good questions queued up, but.
Well, speaking of good questions, we've got a poll. We've got a poll to put up.
Yes.
And it has to do with kind of that target that the Fed has, right, for inflation and keeping that PCE target around 2%. We did some research here at YCharts, and curious to see what everybody would guess as how often CPI actually falls in that target range. Is it 10 to 15% of the time, all the way up to 40 to 45% of the time? So please fill out the poll. We'll see what everybody thinks there. Well, you do. We also mentioned we did some research. So we've got a white paper coming out on Monday where we looked back at historical periods where inflation was in that target range that the Fed is always aiming for, and try to figure out what happened with different asset classes and market conditions. If you'd like to read that white paper, be one of the first to receive it, there should be a link that pops up in the webinar chat here. Go ahead and click on that link, put your email address in there, and we'll hit that into your inbox on Monday. As this chart kind of shows, I think one of the other things we're going to talk about, Charlie, is which asset class performs best. And I think this goes back to one of your tenets, which is it's the same asset class that always performs best, right? Over most time periods, whether they're selected or just randomly picked, it's the S&P 500. So that's the quick piece of information. There's a lot more in that white paper, so sign up for that. And then if we can we get the answer to the poll to show up here? All right. So the prevailing guess is 20 to 25% of the time, about a quarter percent of the time, or about a quarter of the time. The real answer, which is going to be part of that white paper also, is it's actually about a third. So it's just around 35% of the time. So if you guess 30 to 35%, give yourself a pat on the back. Everyone else should probably check out that white paper and learn a little bit more on Monday. But rate cuts are coming. Charlie, you said you're expecting a quarter point cut. Looks like the market's expecting the same thing, but expectations for the rest of the year a little bit bigger.
Yeah, I mean, entering the year, remember, we were already supposed to have cut three or four times by this point. I think the market was expecting 7 rate cuts heading into this year, and now we're looking at maybe 3 or 4. The crazy thing, Caleb, is about a month ago we had that pullback in the markets. Remember that crazy day, and the Nikkei was crashing, and people were calling for an emergency rate cut at that point. They said, you can't even wait to the September meeting. Can't they see that we got that bad employment report? Can't they see recession's coming? The markets are going down, and we need to cut right now. And what I said at that time was that this is crazy. Like, what, you're going to be reacting to a 10% drop in the S&P 500, start doing emergency cuts. There's really no sign of a crisis here. Thankfully, the Fed did not listen to those people. They've said, we could wait till September. I think they want to start out slower here because of the numbers we show. We're not even at 2% yet, and if you look at core CPI, we're still above 3%. And for them to do 50 here as a start at this point, I think would be an admission that something is perhaps much worse than people are saying. And if you look at all of the other major central banks this year that have already cut interest rates, you look at the ECB, the Bank of Canada, Switzerland, Sweden, every single one of them started with 25 basis point cut. So the Fed, they're the last to do it, but I still don't think they want to be a standout here and say 50 basis points. So yeah, this is what the market's currently pricing in: 25, 50, 25, 50, 25. You can almost write it down. This is not what's going to happen, right?
I was going to ask you, is there any like history of this pattern? Why
I haven't seen it. No. So yeah. I have no idea, why the money is being placed this way, but this is going to change. The only one of these numbers that matters is that first one. And the Fed does whatever the market's expecting it to do heading into that meeting. The market's, close to 80% odds of a 25 basis point cut at this point. It's swinging back and forth day to day. But I think if that's the case next week, that's exactly what they're going to do. They're going to do what the market's expecting it to do. Obviously, they're telegraphing it, so they're part of that expectation. But the rest of these all depends, right? What's the next employment report? What's the next CPI report? And so on. And so what happens, with this recessionary data. But 25, I think we start and we go from there. And you can see what the market's expecting here, Caleb. This is the big thing. Below 3% by next year. So very quickly, the market's saying we're going right back down to, let's say, an average rate, in terms of the Fed funds rate. Maybe not average the last, 15 years, right, where we abnormally low zero interest rate policy, but, around 3% would be nothing crazy, like not very high, not very low, perhaps right around where inflation is going to settle in.
So I think we'll get into a visual pretty soon about how fast the Fed cuts rates. But first, the question is, is this what everyone wants? We're high rates bad for stocks. If rates start to cut, is that what we need to see the stock market keep going up in the right direction?
Yeah, it's kind of funny, right? Because you always hear that, especially from market bulls, they're like calling on the Fed, got to cut rates. You got to cut rates. Like, stock market hit 30-something all-time highs this year. We're 33% higher than where the Fed started hiking rates in March of 2022. That's pretty good return since they started hiking rates, and they hiked rates faster than they have since the early 1980s. So no impediment to the stock market whatsoever, these higher interest rates. This is not unusual, by the way. We saw this throughout the 90s. We saw, the higher interest rates and higher Fed funds rate was the best decade ever for the stock market. So the notion that high interest rates by themselves are bad for stock, the historical data absolutely does not back that up whatsoever. And this time is just another example of that.
Could I make an argument, though, that over that same time period, I think the Russell 2000 is only up like 7%. If you look at smaller companies, are they more impacted by those higher rates?
Yeah, that's been the narrative. And yeah, we've talked about that. That's certainly, they have higher debt levels. They have, is this driven in large part by the Magnificent Seven, so on and so forth? Yes. But most people are invested in the broad stock market. Most people have participated in these type of gains, and do small caps. If you look at the full historical data, Caleb, in terms of Fed funds rate versus small cap returns, it's no different than what I'm going to show you for the S&P 500. So yeah, small caps have struggled in the past few years, particularly relative to large caps. We talked about that on the last webinar. We went back to 1999 levels in terms of the relationship between the two. So no question that's been the case. No question. We were talking earlier, who's going to be helped by lower interest rates? Well, smaller companies, assuming those lower interest rates aren't coming about because the economy is weakening, right? So if you're a smaller company, you have to choose between higher interest rates and a good economy, lower interest rates and a bad economy. You definitely want the higher interest rates and a good economy.
So I think this visual you put together is really interesting too, because it kind of shows, maybe a little barbell effect here, where I'm seeing bright green where rates are either really low or really high. What's the story there, Todd? And
Yeah,
why is that?
that is what it shows. But I think by just visualizing that, it would tell you, like, throw it all out. It's all positive, right? Wherever the Fed funds rate has been, whether it's been the lowest quintile, the highest quintile, in between, positive returns 1 year out, 3 year out, 5 year. And the important thing is looking left to right. Looking left to right, right? The average returns, if you're an investor, 3 years better than 1 year, 5 years better than 3 years, 10 years better than 5 years, right? So be a long-term investor. And look at the fact that when this is the bottom chart. I love this part here. The most restrictive monetary policy, so the real Fed funds rate, so that's taking the Fed funds rate and subtracting the inflation rate. The most restrictive, we've seen the best returns, forward returns historically. It's kind of
Yeah.
remarkable, right?
Also,
That goes completely against the narrative. Not that easy money hasn't been good as well. You can see the negative when the Feds had negative real Fed funds rate. Looks pretty positive to me as well. But the fact that really restrictive policy has not been bad for going forward, which is all that matters, right? Going forward should tell you it's not as important as everyone's making it out to be, like parsing every word. Should they do 25, 50? Like, it doesn't really matter, right? Like,
yeah.
there's so many other things that are driving equity returns other than interest rates that you can't separate out this one factor and say, okay, this is interest rates are going to go up, interest rates are going to go down, and therefore stocks are going to do X, Y, and Z. The best thing you could say is stocks will probably be higher 10 years from now, regardless of where the Fed funds rate is.
Yeah, we've definitely talked in the past too, Charlie. I know we've gotten your take on stocks being, basically the best hedge for inflation, and this kind of defends that conversation too, showing that when rates are high and in theory, like CPI was high, you're seeing outpaced returns for stocks too.
Yeah, in the long run, there's no question. Stocks, in the short run, anything could be the leader in terms of relative to inflation. But over the last 100 years, stocks far and away the best hedge against inflation.
Well, there have been some times when stocks haven't done so well.
Yeah, and interesting here, Caleb, that's actually occurred after 50 basis point cut that people are talking about. So I just looked back in history and said, what was the first move after a long hiking cycle, right? Was it a 25 basis point cut or a 50 basis point cut? The two should jump out at you here that were 50 basis point cuts. September 2007, January 2001, right? We had a recession begin January 2008. We had a recession begin April 2001. Obviously had two pretty difficult bear markets in there as well. It took stocks lower. So what I keep telling people who want lower interest rates and who are really imploring the Fed, cut rates, be very aggressive here, cut rates aggressive. If the Fed is doing that, it doesn't have to be, but it could mean that things are much worse for the economy, which in turn is likely to lead to a downturn in earnings. And usually stock market investors don't like it when earnings are going down, especially when valuations, as we'll show later, are elevated.
And we talked about kind of that pace of cuts too, right? Seeing a lot of consecutive cuts. Typically, that hasn't been a good sign in times past, right?
In these two periods, no, right? Like this is clearly it was not a saving grace. So this idea that the Fed can come in and save the day, the Fed put, don't fight the Fed, which is like a saying to say that when the Fed's easing, don't just assume the market's going to go up. Not every time, as we've seen here, the market fell over 50% from 2000 to 2002. Fed starts cutting interest rates in early 2001. They keep cutting interest rates all the way down to 1%. Doesn't prevent a recession, doesn't prevent a bear market continuing, right? Same thing happens in 2007 to 2009. S&P drops 57%. Fed actually starts cutting rates that time a month before the market peaked. So in September 2007, they start with that 50 basis point cut. Market peaks in October 2007, proceeds to go down 57%. Fed's cutting pretty much the whole way down, goes all the way down to zero in December 2008. So this notion that like the Fed can wave a magic wand, cut interest rates aggressively lower, and that can prevent an economic cycle from taking place or prevent a stock market from having a bear market, I don't think the historical precedent backs that up. I think like in recent history, we've heard this, and the Fed has come in, they've swooped in. There's certainly been periods like 2020 where they came in aggressively, and the market rallied very quickly back to new highs. So I think people are remembering that, but don't forget these real longer bear markets that had as a feature of them the Fed cutting interest rates the entire way down.
So if we do see a lot of rate cuts, we see stocks maybe have suffered in those situations in the past. I guess a argument for diversification and anti-correlated assets, bonds are back, right?
Yeah, I mean the 60/40 portfolio is dead, and we did a webinar on that 2 years ago, and saying it's more alive from the bond perspective than a long time because we had rates going up to 5% on the 10-year, and historically that's meant around 5% returns going forward, and you don't know when that's going to happen in the short run, but bonds have done pretty well now over the past 2 years. Over the past year, they've done very well. And why are they doing well? Interest rates are going down. The markets participants are front running the Fed. They're saying, we know the Fed's going to do probably at least 100 basis points here. I mean, they're saying 200 basis points or more in the next year. We got to lock in those higher interest rates now, because all of a sudden that 5% cash yield that you're getting, people are going to be shocked next month when they see a statement like, what went down? We're under 5, and then they're going to be shocked again and again, and not in a good way, but like that's not permanent. That's going down. And so what people did is they start locking that in, and now in the past few months they've been doing that aggressively. So if we look here, the aggregate bond ETF up 10% over the last year. It's actually outperforming that cash yield, and that's really just a function of interest rates going down. We got a 10-year 370. So very quickly the bond market is shifting, and they're not waiting for the Fed to cut interest rates to lock in. Everything moves just much faster these days. It just seems like the whether it's the stock market, bond market, it just moves so much faster, I think, than it used to.
Yeah, and you mentioned that front running the Fed, locking in those higher interest rates. I think that's also why we see people going further out with duration with what they're adding to their portfolio too, to lock in those interest rates longer, which is leading to the yield curve, I guess, making a little bit of a comeback. Something we've talked about a lot, over the last few years, Charlie, because it's been inverted for so long. But I guess the more recent news on the yield curve is that it's not inverted, and that's why it might be a bad sign, right?
It's counterintuitive, right? Because all the attention you get in the media is the inversion. And we talked about it, but we're very clear in pointing out there's a long lag between when the yield curve first inverts and when a recession begins. And on average, it's about 2 years. and at times it's been even longer than that. So this idea that it inverts and you're in a recession right away, not usually the case. Now, we've had the longest inversion in history, which is by itself unusual, but just recently we're flipping back to positive, which just basically means a normal relationship where the 10-year yield is now higher than the 2-year. And that's normal because you're taking more risk and you're locking your money up for a longer term. You should be getting a higher yield. We had this crazy situation over the past 2 years where that wasn't the case. And now we're seeing very quickly the opposite. So the question, of course, is, well, what has happened in the past when we flip back to a positive yield curve after a long period of inversion? And we'll show that on the next chart. But first, I want to just illustrate here. This is what's called a bull steepener. And it's not bullish, I guess, for the economy, but it's definitely been bullish for bonds. But if you look at the relationship here between the 10-year and 2-year, what you'll notice is that darker blue line moving down aggressively faster than the lighter blue line. So the 2-year shorter term yield is moving down very quickly, faster than the 10-year yield, and that's leading to that slope turning positive again. And that's because the expectation that the Fed is going to cut interest rates, so interest rates will be lower 2 years from now, and so those bonds or bond yields are moving down in advance of that, right? So if you look back here, I'm showing you, I think since 1990, before the 1990 recession, before the 2001 recession, before 2008, 2009 recession, before the 2020 recession, you could see this bull steepener in all of those cases where the 2-year is dropping like a rock. And it seems, if we're looking at it, it's just started. If we're looking at historically, most likely, I guess. Like if the Fed is going below 2%, below 3% by the end of next year, you're going to see that 2-year start to continue to move lower.
Yeah, Charlie, I've maybe incorrectly thought about this in the past. So I thought of a bull steepener being when bonds are getting bid up, right? People are buying bonds, but they're buying the short end of the curve faster than the long end of the curve, right? So you're seeing the rates drop on the short end faster. It sounds like what you're actually saying is this is more influenced by the Fed on the short end side, though, because we are saying that people are looking for duration and kind of buying up that long end of the curve too, though, right?
They're buying both, so the both are going lower in the bull steepener. It's just that the 2-year, the shorter term yield is going lower faster, right? It's coming down quicker because of that expectation, right? It's more tied. The shorter the maturity, the more it's tied to Fed policy and Fed expectations.
Okay, great. So back to the question. You know, we snuck the bull steeper curve on you, but here's what's happened. What's happened when that yield curve has gone back to being normal shape?
Yeah, here's the precedent here. So let's go back. March 2007, it flips back to positive. Recession begins 10 months later, January 2008. December 2000, flips back to positive. Recession begins 4 months later, April 2001. June 1989, flips back. Recession 13 months later, August 1990. October 1981, recession actually started a few months earlier. Same thing in May 1980. And if you're looking at these data points and you're saying, well, that's not going to happen this time, then you're saying this time is essentially different. And maybe it is. It's it's every time is different, but to throw this out completely and say, well, it doesn't mean anything, I think that would be difficult to do.
Yeah, and I guess the time bound here seems much more predictive. Whereas, like you said, we've talked about when we see that twos tens go inverted, it's a strong indicator. It's not a strong timing indicator.
Yeah,
this
and look, 13 months is like an eternity in the market. Yeah. So like
you can miss a lot of gains in 13 months, right?
Right. Yeah, absolutely. Right. Like the stock market could go crazy in the next 13 months, right? Higher before a recession begins. And maybe it's not 13, maybe it's 15, maybe it's 20, right? That's the case. Like, or maybe it's not at all. Like I'm not saying that's a 0% probability, but I'm saying this certainly would have to raise the odds of a recession. This combined with that unemployment data that we showed earlier, I think the two of them together it's there's just things building up, right? Historically, that would suggest the odds are higher now of a recession. Not 100%, but definitely higher than a year ago.
What about the 10-year 3-month spread though?
So that
Still
would be the
inverted.
pushback, right? No, we're still in inverted territory here, and that's correct, right? Because the Fed controls the short end of the curve until the Fed actually starts cutting interest rates. Like the 3 month has been trending lower in the last like week or so, 2 weeks, in anticipation of that cut, but it's not going down that fast until the Fed starts actually cutting interest rates. So this is still inverted. It's perhaps people would suggest, well, that has to flip back to positive again. And we're not going to get there after this first rate cut. It's going to take probably a few before it flips back to positive. I think we'll probably get there at some point by early next year. But the whole question also relies on what's going to happen with the 10-year, right? Like we know the 3 month is coming down. We don't know where the 10-year is going to settle in. And that's in large part, the 10-year is not just, yeah, it's anticipating interest rates 10 years from now, but it's also more impacted by things like growth, like GDP growth, nominal GDP growth, like long-term inflation expectations, right? So it's a different kind of expectation there. So we don't exactly know what the 10-year is going to do at this point when the Fed aggressively cuts it. Like, yeah, most likely it'll be lower, and we've seen that with bonds doing well. But how much and what the path of that is, it's harder to predict, right? Because they're not influencing that part of the curve. They're not doing QE anymore. So they're not manipulating that part of the curve. So the market is determining it for now.
All right. Well, we promised to talk about something other than rates and
Yeah,
inflation today. Let's get into let's talk
good.
about AI. The AI arms race. Will it pay off? So people are spending some money on investing in AI. Is that right?
Yeah, and here's the money quote, and any of these CEOs have said similar things in the last few quarters. The risk of underinvesting in AI is dramatically greater than the risk of overinvesting. That's Sundar Pichai from Google. And you can see, like, they're putting their money where their mouth is. 91% increase in CapEx spending over the last year, and a big portion of that's going to AI infrastructure. Microsoft 55, Amazon 54, Meta 33. You go down the line, big tech, like this is an enormous, enormous spend, right, over the past year and ramping up very rapidly, very, very quickly. And so the question is like, can they be doing like a traditional return on investment type of calculation when they're spending this much money this fast? And if you look at their statements, no, they don't appear to be doing that. They're just saying we can't be behind the curve. Like that's a much bigger risk to us than, let's say, spending too much money and having too much capacity, let's say, and perhaps spending too much money too early, right? That's the other risk as well, right? And then the technology changes, it becomes useless, right? That they're saying they have to take that risk, right? Or it's like almost table stakes, right, to get in there. And so the big question for the markets is, well, is this going to pay off? Like we know it's paid off for Nvidia, as we'll show on the next chart here. Will it pay off for the rest of big tech, for companies in general? It's not just big tech companies that are spending on it. Every company, just like every company became an internet company, every company is going to have some portion likely dedicated to AI.
Right. So all that money's gone somewhere, right? All that spending, most of it's gone
Yeah,
here.
it's yeah. Nvidia's just cleaning up, right? 90% market share. They could price it at whatever they want. You're talking about profit margins above 50%, just unheard of for this type of business. And just look at that revenue growth over the past, just vertical, net income too, right? So top line, bottom line, all of
Yeah.
it's going to Nvidia. Like if you look at AMD, it's nothing like this, right? So like the number two company, I'm not saying they're not participating; they are a little bit, but the other day, Nvidia's AMD stock is down on the year, right? So it's such a gap between Nvidia and everyone else, and the question is like, is that spending from Google, from Amazon, from Microsoft, is it going to pay off for them too? I suspect that it will. The question is, will it pay off as much as investors are expecting it to pay off?
Right.
And
Which
how
leads us to
soon?
the next chart, right? Like how
Yeah.
much of those expectations are already built into the market?
Yeah, right. So 2 years ago, like when, AI, was just rumblings about it, but, not a lot of talk about it, right? The market wasn't pricing in much, right? The bear market, it wasn't in terms of expectations, it wasn't there. Now that's a totally different ball game. We have the highest valuation since 2000 here, not as high as 2000, right? But we're elevated, right? So that to me means expectations are high. It means that the rapid growth in the S&P 500 over the past 2 years has outpaced underlying fundamentals. And there's two ways to look at that, Caleb. One is to say, well, the market knows what it's doing here. The market's right. And they're pricing in a big earnings surge ahead, as we'll show in the next chart. And the other thing would say, well, no, that those expectations are way too high. And when reality hits, then that multiple has to come down. So this is a chart showing you estimates today through the end of 2025 for S&P 500 operating earnings. And the expectations are pretty high, 25% jump over the next 6 quarters, essentially. That would be pretty substantial increase, right, over that period of time. You're talking about normally maybe it would be, 9%, right? Like 6% per year
Charlie,
on
you
average.
just spent 40 minutes telling us we're headed into a recession.
Yes. And that's the other question, right? If a recession comes, what do you think this is going to look like? Nothing like the expectations. And what do you think that CapEx spending, what's going to happen there? It's going to come way down, right? So the big point here is not that the AI revolution isn't going to happen. It's already happening. It's going to continue to happen. The question is, are expectations too high? Are we going to see a return on investment for these companies other than just NVIDIA? And how much will it be and when will it occur?
Yeah. And speaking of NVIDIA, right? So we talked about NVIDIA a lot last time we got together, Charlie. We were talking about NVIDIA. I think it was maybe the day of or the day before they became the biggest publicly traded company, right? I think with their market
Yeah.
cap
Yep.
just kind of tipped up right after we were talking about them. We promised that there'd be some ways to have the next NVIDIA in your portfolio, but I think now you went back, you found what was the last NVIDIA that could have been in your portfolio, comparing it to Cisco from the early 2000s.
Some parallels here, right? And I forget who's. I think it's attributed to Mark Twain, but like many quotes, I don't think he actually said it. That history often doesn't repeat itself, but often rhymes. And this is just too kind of perfect to not just bring it up here. Like, and this is back at the end of June when euphoria over Nvidia to me was like at a peak like I hadn't seen before, and I just looked at a few relationships between Nvidia and Cisco back in 2000, which was the leading story stock back in that cycle, and a lot of similarities in terms of valuations. Here we're showing you Nvidia over 40 times price to sales. Cisco didn't get that high, but got pretty close, and huge valuation expansion right over a 5-year period. Like 5 years ago, Nvidia is trading at 9 times sales. Now it's 40 times sales, right? So we saw similar things with Cisco, and then what do we have? I think we have returns that are pretty similar as well.
Yeah.
Over a 5-year period, over 3,000%. I mean, the numbers are just crazy, right? 3,400% increase. Cisco is at 36%, leading to its peak in March 2000. And then the last one here, I think, is kind of fascinating. That's the same company. So yeah, Nvidia briefly became the largest company in the world. Wasn't biggest in terms of net income or revenue, but just the expectations are so high that actually became briefly the largest market cap company in the world. And who did it surpass in doing that? Surpassed Microsoft. And back in 2000, Cisco also surpassing Microsoft very briefly. And then Cisco, this many years later, essentially the stock price is trading where it is back then, and you've had enormous growth in terms of its revenues and its income. The stock price is flat. Why is that? Because the multiple has come down, right? So it's just an interesting parallel. Does it, does it have to play out the same? No, of course not. Probably will be very different from here. But the point I think is that don't these expectations for Nvidia, particularly at the end of June and early July, were just so high. It's just hard to think that that type of move is sustainable. It's not sustainable. We know that, but could this be an indication of something more? Perhaps. And then I think we have a chart here on just Nvidia's volatility, which
It's just the swings, right? It's like
it
the
tends, yeah. So there's
key
an
of
old
roots.
saying, right? And traders often look at like before something tops out, right, or even bottoms out, you just see extreme volatility. There's just so much riding on every little piece of information when you have valuations that high, right? So any piece of bad news, the stocks get slammed. Any piece of good news rallies again, and we're just seeing on both sides this year. If we look at 1, 2, 3, and we had one yesterday, the top 4 market cap gains on a single trading day for any stock in history, all Nvidia, all this year. And look at the top market cap losses. Like this got 8 out of the top 10. So these like wild swings back and forth. It's not hasn't been hasn't been a straight line higher for sure, but I think just this volatility, particularly in the last 2 months, it should be a little bit concerning. It should tell you kind of like a lot of investors that are in this thing have kind of one foot out the door saying, yeah, we know that valuations are pretty high, and any piece of bad news that puts that growth expectation in jeopardy, and we're going to sell first and ask questions later. So just a data point that often happens. And obviously market caps are much bigger today, so you can't look at that alone. But I just think the fact that Nvidia is dominating this, right? Like you're not seeing
Yeah.
Apple and Microsoft, right? It's back and forth. It's swinging bigger, Caleb, than most of the companies in the S&P 500. Their market cap, I think, if you look at almost every company except for 20 companies has a market cap below 300 billion. So at 480 out of the 500 stocks in the S&P 500 have a lower market cap than Nvidia is swinging on a daily basis, which is kind of insane.
And then I think our last chart in this section, just looking at semis in
Yeah, so
aggregate.
when we talked last, this was one of the charts to watch for the back half of the year, and it was the relationship between semis and the S&P was at its highest level since 2000, among many other relationships, growth and value, and small caps, large caps was 1999, but a lot of things. But you could see here, not enormous, but you could see quite a bit of underperformance since then. If we look at the semiconductor index as a whole, and it's almost kind of even with the S&P 500 here on the year. If you look at this index, like barely outperforming now, and just I think at the end of last week it was actually underperforming on the year. So if you take out Nvidia, which you can't do, obviously, because it has, of the market share it has, like the average semiconductor company is not booming today, and this is an interesting thing that we're seeing because to me, semiconductors are always a leader for tech, and tech tends to be a leader for the market as a whole. It's the biggest sector in the market. So to see that underperformance after a long period of outperformance is something to watch, I think, for sure.
Hey, Charlie, one of the questions that came through in our Q&A here, which we might have time to get to a couple, but is whether or not it's true that semiconductors are negatively affected by rate cuts. Is there a theme
Yeah,
here related to that?
negative. So they're saying they would be
The rate
hurt by
cuts would be
interest rate
bad for
cuts.
semis, yeah.
Not sure why that would be the case. It's not like these companies uh, should be helped or hurt. I mean, they don't have a lot of debt if we're looking at Nvidia or some of these other
Right.
semis. So they're not particularly sensitive to it one way or another. So I'd say this is kind of coincidental but they certainly would be hurt by a weaker economy, right? And as we've talked about,
R&D
if
spending going down.
if lower interest rates are correlated here to a weaker economy, and that's not always the case, but if it is the case, then perhaps that's what we're seeing as a response here. But no, there's plenty of times where interest rates have come down and semis have done done very well.
So is it a sign for tech in general?
That's the question. I mean, this is the big one, right? Because we surpassed the peak ratio from March 2000 in July, and just like March 2000, we've seen pretty sharp underperformance over the past month and a half here, and no one knows if it'll continue. What we do know is that the last 10 years have been pretty much as good as it gets for tech.
Compared to, yeah, there we go. Versus the other defensive
Yeah,
sectors,
and
right?
like if we did a poll on here asking, now they could see the chart, but asking what would be the number one sector in the S&P this year, I don't think many people would pick utilities, right? It's been overall a pretty strong year for the markets. That's a very unusual thing. And yeah, I know interest rates are coming down, expected to go down, and utilities are a sector with that tends to have a lot of debt, capital intensive. They definitely benefit from lower interest rates. So that's part of the story. But you also have things like consumer staples here, right, taking leadership. So the defensive areas of the market that tend to do better in a slower economy are starting to outperform, and the more cyclical areas like tech, consumer discretionary, underperforming, right? Opposite of what we saw in 2023.
The Nasdaq's been on a run though. It's been on a tear.
It's a remarkable run here. We're looking at 378 straight trading days above the 200-day moving average. That's the fifth longest streak in history. This index goes back to 1986. And what I want people to focus on here is look at those top five. Look at the dates there. They're all within the last 11 years or so, right? So like this has been just a phenomenal period in terms of long uptrends, big gains in those uptrends, and you could see it on the chart here, right? And just you get below it, yeah. Look at the 2022. That was the longest period, I guess, where we didn't have that uptrend. We had that bear market, but we just have one big run after another, and this is highly unusual, right, for markets to be this smooth this many times in a decade. So the overall point is don't expect this for the next decade. I'd love to see it. It would be incredible, but the odds I think are not very high. And just go back to that table for a second here, Caleb. Some interesting dates if you look at some of the longest streaks here when they ended. Right, you have May 2000. Right, that kind of jumps out. Right,
Sure.
obviously bear market starts in March. January 2022 bear market. Right, 2018 October, that was the start. Quick bear market, 20%, but a bear market. October 2014, it's a sideways period for markets, right, over the next year or so, right? So I think at some point, obviously, next month, 2 months, whatever, this streak likely will be broken, and now you're talking about a transition to a different type of market, perhaps, where it's more difficult, right? This is just a very smooth period for the market since March 2023, particularly the biggest stocks.
Yeah. So it seems though, like, I mean, maybe, my memory's not going back fast enough, but or far enough, but the quick, rises we see, some of these companies like Nvidia, like Cisco, they're going to be in tech again, right?
They're going to come back, you're saying again,
No,
or
it'll be in the tech sector where we see the big rise. If we go to, I think our last chart here showing Nvidia and even the other big tech companies, it just feels like being in tech is still where you're going to capture those huge outsized gains when things do move.
probably, but that's that's because we have recency bias, right? If you look at the top
Yeah,
stocks over a 30-year period, last 30 years, I put out that table a lot that I pulled from YCharts, and there's a lot of non-tech names in there. I think like the last 10 years have really distorted our view in terms of saying like you only make money in tech over the long run. That hasn't been true, right? It's been participation with it's a pretty diverse economy, many different sectors, but clearly the last 10 years belong to tech and Nvidia. I called it the Caitlin Clark of the stock market in our
that's right.
last video. and it still is like 24,000% in the last 10 years. It's just insane. Amazon 1,000%, Microsoft, like it's nothing. It's just, this is not normal. This is highly, highly abnormal, and I don't think we appreciate it because these are the leading companies. These are the companies we use every day, and it's hard to imagine, as you said, there being anything else. Being a leader, we've been talking about that concept for the past few years in terms of when is this going to flip. You look at the Nasdaq 100 relative to the S&P 500, it's still kind of sideways over the last few years. So it hasn't gained ground, but like these enormous gains that we had up through, let's say, the end of 2021 have just been so remarkable relative to the market that the only comp is the 90s. And I think the difference with the 90s, Caleb, versus today is these weren't as entrenched in people's everyday, like Cisco. I
Right.
don't know, people in the 90s, like they knew, maybe heard of Cisco, but they weren't using it every day the way they're on Amazon ordering something or have Microsoft software. They have their iPhone. They're out watching Netflix, right? Maybe they're on Facebook. I don't know why anyone would be on that platform, but they're doing something on there, or they're using Google, right? It's just like every single one of these. So no, they're not going away. The question is, are they going to continue to be the leaders that they have been and see this type of wide outperformance? And I think that only happens with like that AI thing that we talked about earlier, that investment paying off, right? So it has to pay off. It has to pay off big. If it doesn't, then they're vulnerable because valuations are higher. Like all of these things are trading. If you compared all of these numbers here in terms of returns over the last 10 years to their net income growth, this number is way higher, right? So you see multiple expansion across the board. Like Apple was a value stock 10 years ago. It's not a value stock today, right? It's hard to imagine. It was trading at a P like
Yeah.
10 years ago, right? So very different company today. And that's one of the reasons Warren Buffett's selling, right? It's like it's still their biggest holding, but don't kid yourself. Like they're not just selling it because they won't want to sell now before tax rates goes up. They've recognized like this is a pretty good gain. They've made 1,000% on this stock. It's trading at 35 times earnings. Like, at a certain point, a
Yeah.
value investor has to look at value.
And Berkshire is the latest member of the $1 trillion market cap club, right? And sitting on
Yes, sir.
cash. So
Yes, sir. So there you go. Not well, I guess given their Apple holding, like you could say they are in part a tech company, but uh, insurance, right? Boring insurance. We didn't talk about insurance rates, but we'll save that for the next one. That's one
we'll save
inflation
that one.
piece that's not coming down, unfortunately.
Interesting. Do you have time to take a couple questions?
Yeah.
I know we're a little bit
Yes.
over here. Let's do a
What
couple.
do we run? Okay, we were a little bit over, but yeah, let's take a few
Pretty close.
questions.
Pretty close. We'll call it a
Not too
win.
bad. Covered a lot of ground, so I mean, not bad.
Yeah. So I'm just
Yeah.
so one question, we talked about the Fed starting to make cuts. Question, what do you think they'll do with their balance sheet? Are they going to continue to let it run down, or will they stop, running down not long after they
Yeah.
start?
Good question. We'll see what they say at this meeting here. I think they're getting closer to probably a pivot. I mean, the balance sheet is now down 20% off of the peak. Like we're back to late 2020 levels. So a good amount has come off. They've nowhere near erased what they did in 2020. In my mind, they shouldn't reverse. They should continue. But is it likely with the Fed cutting interest rates aggressively in the next year that they're going to keep trimming their balance sheet? Probably not. People keep pushing them, saying they got to stop. They shouldn't stop. They shouldn't keep letting it roll off. I don't know, but I would expect them, Caleb, if there's a recession, if there's more economic weakness, if there's a reason for them to cut rate, they're going to go back to the old playbook. Like they know one thing and one thing only, and that's to like bring back QE, bring back buying mortgages, bring back buying treasuries. That's what they know, right? That's their playbook. And until Congress acts and says you can't do that, they're going to keep doing it.
Another question here.
So they've already,
We
by the way, they've already slowed it down, right? They've already pulled
right.
back. They've already
Yeah,
tapered
I
the,
think
yeah.
the question was if
But
they would
yeah, yeah,
keep doing that once they start cutting rates.
yeah.
But
Go ahead. Next
um,
question.
yeah, another question. So we talked about the Russell 2000 underperforming. Question was, is that underperformance? Is there something else there other than just higher interest rates and not partaking in like the AI wave and some of those other like big tech gains?
Yeah,
Is
I
there more
think
to it?
yeah, I think there's a structural component to, the average small cap stock is not the same as it used to be because of this delay that companies have in going public and the increase in private equity, and it's just delaying the best companies from coming public. Where like Amazon went public in the late 1990s, didn't have a huge market cap at all. Like that would never happen today. Like these things are coming public much bigger, right? In terms of their size, they're not small caps. The best companies by the time they go public, there's a lot of private credit that continues to expand. So the case to be made to become a public company faster earlier in the life, like unless something changes, that has kind of changed. I think the fundamental makeup. That's not to say that small cap stocks will never do well again, right? But it's a meaningful change, and it's reasonable to think about that. So a lot of people talk about though, well, which small cap index are you looking at? And they say the Russell 2000. There's a lot of garbage stocks that don't make any money, and I agree with all that. And there's perhaps better small cap indices out there in terms of looking for quality or value, for sure. So like I would, all else equal, I would prefer that type of small cap. But I think overall, it's just small caps haven't seen the earnings growth that large caps have, right? It's just the spoils have gone to the biggest companies in the past decade, and the average company just hasn't nearly as participated. So like Amazon, just think about how many businesses Amazon's crushing, right? That are smaller than them. You don't hear about them, right? But every day, probably another
Yeah.
one going out of business, right? That you don't hear about, and just how challenging it is to fight these giants, right? Which is why all of them have antitrust cases going on against them right now. So
Right.
we'll see what happens with all of that. But yeah, that's
Right, but
my take on it.
we were all kind of taught like in school like law of big numbers, like it's harder to double a bigger number, right? That just hasn't been the case. We've seen these
No,
huge
this
companies have plenty of growth potential.
that's been what's so crazy, right? In the past 10 years is the biggest, most dominant companies have persisted. And that's an outlier. That's abnormal. Usually the leaders in one decade fall. They don't have to fall in absolute value. They usually fall in relative value, right? And new leadership emerges. This is the first time that we're seeing the big four, the big five remain. Like Nvidia wasn't part of the discussion, right? A decade ago, but the rest of Apple, Amazon, Microsoft, Google were, right, and they still are, and that's been the biggest the change. The big have gotten bigger, more dominant, and is there some type of limit to that? Like, are we at that, or did we hit that back in July when all of these things hit their extremes? We didn't show the concentration chart we showed it last time, but the concentration in the top five were record highs, right? Back in July, and will that shift? So, you know, eventually there'll be disruption. So, someone new players will come in. That's the way free markets work. But they have these natural monopolies that are very hard to break, perhaps much harder than companies in the past. And we'll see how all of these different antitrust suits shake out. I don't have any big predictions other than I think some of them will stick and things will look different. But how do you take away that dominance of everyone's on their phone, right?
Yeah.
And they control the app store, and they control search, or they control, like, you literally have to just break these companies up. Like Google, Gmail has to be separated from YouTube, which has to be separated from search. It's just, maybe that's coming, right? But we're not there yet. Certainly they're benefiting from having all of those different aspects to their businesses.
Indeed. All right, Charlie, I think we should probably wrap up. There's some more good questions here. Maybe we can take a couple of them offline. But
Okay.
would like to say thank you. Always enjoy the time with you. I know we get a a lot of great feedback of everybody that appreciates your insights. So thanks. Look forward to doing this again soon. And, again, if you're not already following Charlie on X and reading his blog, make sure you're doing that.
Awesome. Thanks everyone for joining. Thank you, Caleb. See you next time.
All right. Bye, everybody.